Imagine waking up to a world where the US dollar, USD, the bedrock of global finance, has collapsed. This scenario may seem far-fetched, but it's a narrative often found on dubious platforms pushing gold, crypto, and extremist political views, and it occasionally creeps into mainstream discourse. The greenback has always had its external foes during the long period of its dominance, from the communist bloc and anti-colonialists to contemporary adversaries like China, Russia, and other emerging powers. Meanwhile, critics argue that mounting inflation, the rising U.S. federal deficit, and government entitlements could bring down the USD's dominance from within. Given the ever-present economic and political uncertainty of geopolitics, pundits have predicted the dollar's collapse ever since the greenback gained worldwide supremacy. Nevertheless, we shouldn't be too sanguine. History shows that even the sturdiest of human edifices crumble, becoming ruins future generations barely notice as they trammel them underfoot. To be clear, there are no such signs on the horizon. While about a fifth of the foreign currency reserves of the world's central banks have moved away over the last quarter century, from 71% to 58%. That's still a dominant position of strength for the greenback worldwide, let alone as a worthwhile currency within the US. In simple terms, a currency collapse means that the money people use every day loses its value rapidly, making it difficult to buy goods and services, repay debts, and maintain economic stability. Here are the types of crises. The examples are our own. Crises with current account problems. These crises are marked by a loss of competitiveness, often because of real exchange rate appreciations. This can happen because of various factors, including overvaluation of the currency, rising production costs, or trade policies that disadvantage domestic producers. When a country's goods and services become too expensive for foreign buyers, the demand for its currency falls, leading to devaluation and potential collapse. Example: in the early 2000s, Greece's debt crisis was driven by catastrophic levels of foreign debt. The country's inability to service its debt led to severe austerity measures and a dramatic devaluation of its economic stability within the Eurozone. Crises with fiscal deficits. These result from expansionary fiscal policies. When investors perceive that a government is unable to manage its economy effectively, they may withdraw their investments, leading to a currency collapse. Example: Brazil faced a currency crisis in 1999, exacerbated by large fiscal deficits. The government's expansionary fiscal policies led to a loss of confidence, resulting in a sharp devaluation of the Brazilian real. Sudden stop crises. These occur because of sudden reversals in capital flows, typically triggered by sharp increases in global interest rates. These crises, then, are externally driven. Countries heavily reliant on commodity exports, like oil or metals, can see their currencies plummet if global prices for these commodities fall sharply. Example: in 1994, Mexico sustained a sudden stop in capital inflows, triggered by a sharp rise in U.S. interest rates. This external shock caused a massive outflow of capital, leading to a severe devaluation of the peso. Self-fulfilling crises. These occur without any apparent domestic or external vulnerabilities. In conclusion, while the concerns about a potential collapse of the US dollar can be alarming, it's important to stay informed and cautious. Monitoring economic indicators and understanding the underlying factors can help you navigate these uncertainties. Stay tuned to reliable sources for updates and insights into how these issues might unfold.